Your retirement benefits are so important. This is why I dedicate the majority of my time, all the videos on this channel, to just covering these benefits. A lot of people will sometimes bring up and ask, do I talk about anything other than benefits? And while I do, the benefits are what I focus on because it makes up the majority of your retirement account. If you just step back and think about it, what are your employer benefits? It's your Social Security, it's your pension, it's your Plan 3 defined contribution plan, 403B deferred comp, your PEBB healthcare, your VEBA plan for additional medical savings. So there's just so much of your retirement that is through your benefits that ignoring it and trying to focus on the investment side of things, which is what most advisors like to do, is just the wrong way to look at it. I've seen so many advisors give wrong advice because they didn't take the time to understand your benefits. They put you on some other path so they can make more money, making you work longer, pay more in taxes, pay more in fees because they didn't take the time to understand your benefits. So if they're not going to do it, you need to be in charge of your own future and be in charge of your own benefits. So let's go through your benefits. So benefit number one is pension. Most people know that they have a pension at this point. If you don't, just know that if you're working in Washington State, you're probably going to have some kind of pension in the future. There's different pension systems and options. Primarily, you're looking at Plan 2 and Plan 3. So those on the teacher retirement system, the public employee retirement system, or the school retirement system, they're all the same for the most part. Your contribution rates may change a little bit, but as far as how they work, payout rates, all that, they're pretty much all going to be the same. Now, those that are law enforcement and firefighters, they're on left Plan 2, a little bit different of a system. They can retire earlier. They have now a new enhanced benefit for a 10-year period of time. So that's a little different side of it. You understand how your pensions work. I'm not going to go into detail on each and every one of these in this video, but I have multiple videos on this channel that you can explore to dive deeper into that. But you need to understand how your pension works. This is also important if you're ever going through a divorce or something, because I've just helped a person recently who went through a divorce. The attorneys didn't understand the system. The judge also didn't understand the system. So the way they divvied up assets was just completely wonky. They took half of his Plan 3 pension, didn't take any of his defined contribution plan, and then they slapped him with a bill for $350,000 that he owes his wife because he didn't have enough assets to split. Why didn't you just take half of the Plan 3 contributions and not force this guy to take a huge second mortgage on his home? It would have been so much easier if the courts understood this, or if this individual understood it, so they could have divvied up the assets a little bit differently and not have to force someone to fire sale on the home if you wanted to sell it, or be forced to take on another mortgage at 7% interest. And this guy's in his 60s, so he's going to be paying it probably for the rest of his life. And it's just an unfortunate situation that probably could have avoided if everybody knew how the pension systems work and how to properly divide assets. Next benefit is healthcare. Healthcare is a huge benefit that a lot of people forget about, don't talk about. So Washington employees primarily are on two different systems. For school district employees, you're on SEBB, the School Employees Benefits Board. This is healthcare while you're still working for the school district. Outside of that, if you're not working for the school district, you're on PEBB, the Public Employees Benefit Board. Teachers that are on SEBB will enroll into PEBB after retirement. So you move from the SEBB system to the PEBB system. If you're already on the PEBB system, you're going to stay in the PEBB system. Now, PEBB is your primary healthcare while you're employed, covers spouse and children as well. Once you separate service and retire, you can still be on this plan. Costs go up because you're not being supplemented from your employer anymore, but you're still able to get healthcare from the state. Now, the healthcare that they offer is pretty good from a coverage standpoint. Cost-wise, it's going to be a little bit more expensive, but if you want to compare apple to apples, you can always go over and see what's available on the exchange. Keep in mind that as soon as you leave PEBB coverage, you can't go back on. It's a one-way road. So if you want to go chase a cheaper plan early retirement and you cancel your PEBB system, and then later on those other costs go up, you can't get back on the PEBB. So for the most part, all my clients are in the PEBB system. They're usually on the higher end of the plan options, and they have no regrets with it. Yeah, cost hurts, but as much as they cover, if they say it's worth every single penny. Now, that PEBB system will cover you up until you're age 65. After that, Medicare kicks in. PEBB now becomes your second to pay. So it's PEBB for retiree coverage. So you can still be on PEBB even if you have Medicare. It just becomes like your Medicare Advantage plan. The cost does go down because you're not using it as your primary healthcare anymore. It's the second pay option. So those are really good healthcare options you need to look at if they're available to you. Next benefit a lot of you overlook is VEBA, Voluntary Employee Benefits Account. It's kind of like a health savings account, but it's technically a health reimbursement account. So for the most part, you're able to put money away into this account on a pre-tax basis. So you get a tax deduction, it goes tax deferred, and it comes out tax-free as long as you use it for healthcare expenses in the future. Now, some employers allow their employees to save into it. Most don't. For a lot of employees, the only way they get into VEBA is to roll any unused sick leave into the plan. So when you go to cash out your sick leave, they're going to give you a dollar amount, right? So it's however many unused sick leaves you have multiplied by what they determine your daily wage to be. And that's how they get the total amount. So for example, if you had $10,000 of unused sick leave that you needed to earn and you wanted to cash it out, you'd only get a 4-to-1 exchange rate. So it's worth $10,000 because I'm cashing it out. I only get $2,500. Of that $2,500, it now becomes taxable income. So I'm going to have to pay taxes on that. The alternative is you can roll that $2,500 into a VEBA plan. That VEBA plan will take that money on a tax-free basis. So you pay no tax on that money. So you keep the full $2,500 working for you. It goes into VEBA. If you want to let it ride and invest it, which you can do inside the VEBA system, it'll continue to grow. You can withdraw it to pay for healthcare at any point in the future, and it all comes out tax-free. So it gives you another way to give you some tax savings, some potential growth, and to use for healthcare. A lot of people use this to pay for healthcare early in retirement, especially if they're retiring, before age 65. Next up is your different savings options. So depending on your employer, you're going to have 403Bs if you're working for nonprofit or school districts. And pretty much everyone has the option to save into a deferred compensation plan or a 457 plan for the most part. Now, these plans, they're two different tax codes, and you can save into both of them independently. They have independent limits. So if the limit, for example, is $30,000 for the year, you could do $30,000 to 403B and $30,000 to DCP for a total of $60,000. So this is a primary benefit for people in the school district system because they have both options available to them. And if you have the means to do so, you can max both of them out and reap the benefits of each one. Now, the 403B allows you to access money at age 59 regardless of your employment status, whereas deferred comp, as long as you're employed, you can't touch that money. So there's a lot more differences between them. I got multiple videos on this on the channel as well. The thing I want you to understand at this point is that there are multiple options available to you to save in the future above and beyond what you're doing in your pension already. And you can use these for pre-tax savings or for Roth savings. So if you want to start growing your money tax-free, that's Roth. If you want to take a tax deduction now and pay taxes later, that's pre-tax, which is the default for most of these options. Final benefit is Social Security. Now, a lot of Americans have Social Security, but not all teachers have Social Security. For example, teachers in Alaska and California and multiple other states don't pay Social Security. So a lot of people take it for granted. Washington does. When you're doing your retirement estimates, you not only need to figure out what your pension is, you need to figure out what your Social Security is. You add those two numbers up, that becomes your base income in the future. So any distribution you take will be on top of that. A good exercise is always to figure out what's my base income. So worst case, if I stop working and didn't earn another dime, didn't pull anything out of my retirement accounts, what is my guaranteed income going to look like? And that's just the total of your Social Security and your pensions. And that alone will surprise most people with what their guaranteed income is if you've worked a significant amount of time for Washington State. Now, a key thing with Social Security is people get this confused with their pension all the time as far as collection ages. So Social Security has three primary collection ages. Age 62, the earliest you can touch it. And then there's age 66, 67, depending on your birth, that's considered full retirement age. All that means is the age you can collect it and still be earning an income without incurring a penalty. So if you collect anytime before your full retirement age, there's an income cap on you. You can't make over a certain threshold before they start withholding part of your benefits. And there's another threshold that once you go over that, you don't get any Social Security. So if you're working and earning more than this income, it doesn't make sense to take Social Security early because once you start collecting Social Security, you don't get the deferral credits. Every year you wait past 62, your benefit increases up until your full retirement age. Now, the third age to know is age 70. That's your max Social Security age. So that's truly the most you can get from Social Security. Your Social Security benefit increases by about 8% per year between your full retirement age of 66, 67 up until 70. So some cases it makes sense to wait, others it really doesn't. So those are the three things you need to know. I hear a lot of people mixed up that they can't get their pension until 67 or they have to take their Social Security at 65 because that's what the pension number is. Remember, they're separate benefits, separate limits. A lot of people get the ages mixed up. Next benefit we're going to go over is Medicare. So remember, Medicare doesn't begin until age 65. They have Part A that begins, which is free. All you got to do is enroll in it. And then Part B begins basically whenever you want to enroll in it. You can enroll in it as early as 65, but if you're still working and covered by your current employer or if your spouse is currently covering you, oftentimes you can just defer that coverage to a later date. Now, the amount you pay for Medicare is directly tied to your income. So the more you make, the more you pay. There's a base level that everybody pays, and then once you hit a certain threshold, you start earning more, or you start having to pay more. And when you go over just by a single dollar, that payment increase is locked in for the 12 full months for you and your spouse. And those jumps can be as high as $70 or $100 or more per month. So this is something you really need to watch for retirement. They also have a 2-year look back period. So if you're making bank, let's say you're making $200,000 a year at 63 and you don't retire to 65, you still may be paying higher premiums for your Medicare because they're going off of your wages from 63, not what you're currently making at 65 now that you're retired. Other benefit I'll just mention because some people bring it up for some reason is Medicaid. Medicaid is like a last resort option. This is primarily meant for the poor, those with no assets. Typically, you have less than $2,000 or so to your name in order to qualify for this. Now, there are some exemption stuff that your spouse can keep, as much as maybe 30, 40,000, something like that. But the key is this isn't something you should really be banking on or think that it's free healthcare, because it's definitely not free. You have to spend down all of your money to get under these limits just to qualify for it. And even if you qualify and they start paying out, that's still not free. They're going to come after your estate down the road. They'll put liens on your house and do whatever they can to recoup the money they pay for healthcare. So Medicaid is something you want to avoid at all costs. But I've heard multiple people kind of bank or rely on that or think that that's an option for them for some reason or another. Until next time, remember that your future depends on what you do today.